Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome back to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Andrew White, back from Char Technologies to give us an update. Char trades on the TSX Venture Exchange under the symbol YES and on the OTC under CTRNF. The company is currently trading at 36 cents with roughly 83 million shares outstanding, or about a $30 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Yeah, good to have Andrew back. Andrew, you've been with us a few times in the past couple of years, and we've been happily following the progress of the business. But we sort of caught you a few days after a pretty big event for you guys. So I want to thank you for joining us so quickly after that and allowing us to get updated. But before we sort of get into some of the things that are happening, why don't we refresh our memory in terms of what Char does?
Yeah, absolutely. And Paul, it's always a pleasure. And so we really appreciate the opportunity to update your members on kind of what's been going on since we were last on. But for anyone who's new or anyone who needs the refresher, we'll kind of do the quick 5 minutes about what we do. So as you can see here, decarbonizing for a circular economy is really the basis of what we do. And what makes it an interesting model is that we do it in a co-product fashion. So we're always producing two products out of our technology, two revenue generating products. So I'll kind of explain that a little bit more as we go through some of the slides here. We won't go through all of the background ones. I'll just quickly pause here. This is a slide I've started to put up. One of our two products is biocarbon. One of the subsets of biocarbon is biochar. And these are three different Toronto restaurants that have started putting it in their food products. We don't make food grade biochar, but I think it's a nice visual. I've eaten all of these. I can attest they're all taste pretty good. So there's all sorts of uses for the product. We'll skip the thermochemical conversion. We'll go straight to the kind of what is it, and I'll explain from this slide. So in the center here is our technology, high temperature pyrolysis. And all that really means is we're heating things up in the absence of oxygen. That's the pyrolysis part. The high temperatures, 850 degrees Celsius. So under those specific conditions, we do what's called thermochemical conversion. So instead of something burning, so that's a type of thermochemical conversion, just your fireplace burning a log of wood, we're heating it up, but since there's no oxygen and since there's no source of ignition, the material doesn't burn, it thermochemically converts. So it basically breaks apart into a gas and into a carbon. And so we're always making gas and carbon. On the gas side, as it comes out of our system, it's called syngas, and we can further take that to things like green hydrogen or renewable natural gas. On the carbon side, this biocarbon. Like I said, we don't actually sell it in the food industry, but the two prime market opportunities there is our clean fire product. So that's a biocoal, so that replaces fossil coal in steelmaking, or biochar, which can be utilized to sequester carbon. So there's an ability to generate carbon credits in voluntary carbon markets. So again, just basically turning low value materials. On the far left, you see wood and agricultural, biosolids, digestate compost, and converting those into these two co-products, the gas and the carbon. So fundamentally, that's what we do at a high level. And just sort of one quick slide here, this is what it looks like. So this is our plant. This picture is when the plant was in London as part of our recent announcements. About a month ago, we announced $1.5 million from FedDev, which was to support moving this kiln from London to Thorold. That move's now been done. The kiln's in the new location, and we're expecting to finalize recommissioning by mid-January and have it back in operation. So in kind of the quick, the last piece here, to talk about business models. On the left is a project we have with a client. So in this case, we're selling basically a system, selling a project to them, but it's theirs. On the right, Thorold, that's what the big funding announcement was for. That's our own project. That's build, own, operate. So we have kind of these two pathways. We're either working with clients to sell them systems to help enhance their operations or create additional value out of some of their residuals, or we're building our own projects where we're really able to capitalize on these long-term offtake agreements for things like RNG. So in, I don't know, 180 seconds, I don't know my timer going, but in quick fashion, that's what we're about.
Fantastic. So yeah, let's talk a little bit about the projects, I guess, because that's your revenue generation is going to come from either selling project or, in the case of Thorold, owning it. What's the timeline for these things? What does schedule look like?
Yeah, so for the Thorold project, for example, we expect initial revenue generation by the end of fiscal 23. We're able to start generating biocarbon while we're still sort of finalizing the rest of the facility. So as you know, I've kind of said, we make carbon and gas. The carbon we can make with less equipment, so we'll get the plant making carbon, and then we'll be adding the gas piece. So initial revenue is late 23, and then sort of full revenue generation mid 2024.
Mm-hmm. And ballpark, what does a facility like this generate? What are sort of the windows or the parameters of revenue that you can generate from that?
Yeah, so Thorold will be between 15 and 17 million a year in revenue. That'll be driven around 70% by the RNG price, and then the 30% will be from the biocarbon, and this particular facility will have a focus on bio coal. So that's metallurgical coal replacement.
Okay, cool. 15 to 17 million. Now, you recently received further funding. I think it was 11.5 or 11.8. I can't remember the exact number. What does that do? And is that sort of what you need to get this up and running? Do you need to get further financing, or do you have the financing necessary to do what you need to do here?
Yeah, so the 11.8 was from both the province and the federal government. It's basically 50% of the total project budget that's now covered. The nice thing about the Thorold site is that it's, as you can see from the picture here, it's a former pulp and paper plant. So we're not this whole site, we're one of the buildings on the site. And because it's brownfield, it has a building, it has all the utilities, it has all these benefits. The development timeline and costs aren't as much as, say, a greenfield development. And sort of back to my earlier comment, we can get to carbon production with the funding that we have received. So we can get to that initial revenue generation with the funding that we have received. So the total project budget is to, get all the way to making the renewable natural gas. So we will, need a little more project finance to get to that sort of 15 to 17 million a year in revenue. But we'll be able to get to that initial revenue piece with the money that's available now, which is great.
Yeah, and I see the slide here. It looks like, I can't really quite make out the number, but is it 72,000 tons per year of woody biomass?
That's right. Yeah.
Okay.
Yeah. So
it does like, can you source that much? I mean, it seems like a fair bit of wood mass. Can you source that in that area?
We can. We have a great feedstock supplier who we've got a good offtake agreement with, a good relationship with, who will be delivering the material. As you can see, we're this site in Thorold's called the Thorold Multimodal Hub. So it's serviced by, we're on the Welland Canal, so it's serviced by marine, by rail, by road. So we do have a really good capacity for logistics to bring in more biomass. About half of that is going to come locally from things like used shipping pallets, really clean wood waste, and then the rest will be sourced. But because of its location, we are able to bring in material. Because this was a former pulp and paper mill, they were processing significantly more wood than that a year. And actually the building we're in is called the wood room. So it's the room they used to send the logs into to be debarked, and that kind of first step in making paper. So it's kind of a nice closure on the site.
Yeah. So is it mostly sort of wood waste? Is it the bark and the sort of the waste pieces from either lumber or pulp?
Yeah, exactly. It's a combination in this site. It's a combination of sort of Southern Ontario wood waste. So that's things like shipping pallets, and then forestry industry residuals. So the residuals are the things exactly that, like bark. The concept that always stuck with me is, we're trying to make, something round from a log into something rectangular as structural lumber. So there's going to be something that doesn't kind of make the cut, so to speak. So it's all that residual material, and to kind of put that in another way, Deloitte and WSP did a study for the government of Quebec, and they wanted to see what the techno-economic capacity to produce renewable natural gas in Quebec was. And they showed under first generation technologies, which is called anaerobic digestion, kind of food waste, farm waste, etc., they could make on the order of 20 to 25 petajoules. Now, petajoule, is irrelevant. Just think about the number 20. When you add in woody residuals, that 20 petajoules goes up to 140 that could be produced. So this is sort of the amount of and this is just residual. This is not sort of going in and harvesting trees. This is residuals. So it gives an idea of just what the production capacity using this type of technology is.
And I mean, you're using waste product. What's happening today when companies like yourselves aren't taking this waste product? What happens to that right now? Is it going to landfills? Is it being burned up? What's it being used for?
It's basically a combination of both of those. So there was a reasonable supply chain of the residuals going to power plants that were burning it for power production. Some of these plants are shutting down, or they can't get the power price needed to make the economics work. And if that's the case, then there's no other home but landfill. And with sort of current permitting conditions, a landfill is not permitted in 12 months. So it's got to go a fair distance, and that puts a pretty significant economic strain on the forestry operators, both from sort of the logging through to the sawmill operators and the like. So there is an abundance of the material, and it really does need to find a home right now. And I think this is a fantastic home, a great way to put it to value, that sort of decarbonizing for a circular economy that we like to talk about. Is it's all about taking this type of material, low value residual waste, and creating these higher value opportunities out of it.
Now, Andrew, we saw the what's it called, the Inflation Reduction Act in the U.S. What kind of impact is that having in either the interest in what you guys are doing, or just generally, has it made it easier, harder, more confusing? What's it done for you guys?
We'll call it, can I pick two of the three? Easier and more confusing. So when you kind of delve into it, the IRA, Inflation Reduction Act, has some elements that certainly apply to our business. The primary one actually ends up being on the green hydrogen side, because there's a little bit less limitation around there. They are doing something that I would love to see the Canadian government did. They kind of, in the fall economic statement, tried to do something to catch up, and hopefully we see a lot more. But in the States, what they do is they measure the value of hydrogen on what's called carbon intensity. So that's actually how they do renewable natural gas in the United States as well. It's how many greenhouse gas emissions are associated with the production of that product. And for us, when we're looking at woody residuals through high temperature pyrolysis, we actually have phenomenal carbon intensity. When you look at green hydrogen production through electrolysis, which is how most green hydrogen is made, splitting water with electricity, it's only as green as the power grid. So if you're making green hydrogen in a state that is full of coal production, now your carbon intensity is actually much higher than ours, because you're basically burning coal to make electricity to split your hydrogen. So the nice thing, it in a way levels the playing field, and it levels it in a way that makes it advantageous to us. So I don't know if I think it's still leveling it because it's looking at what's really important here. There's some elements, some of the projects, you kind of need shovels in the ground very, very soon for those pieces to apply. And then, in some cases where we're working with, anaerobic digestion partners, there's kind of a bit of a confusion as to where can you draw the line, where can you get investment tax credits versus production tax credits. And for us, it's the PTCs. So that's basically a premium on the green hydrogen price based on the carbon intensity. But if it's on another site, so there's a few things to work out, but I think it's a great step. And I know, I don't know, I'm fairly optimistic that the Canadian government will continue to try and catch up to it, and we'll see kind of a push on programs here as well.
Are you seeing anything else that's happening out there that is sort of either legislatively or, economically, or anything that makes it is making it easier for you guys?
I mean, I think the demand for RNG now is clear, and that's growing. And for us, that means we're seeing the price increase. So again, back to that Quebec example where, just using organic waste and food waste, they can only make 20 petajoules. Quebec needs more than that to meet their 2030 targets. And because of that supply demand gap, we are seeing prices continue to go up, and they're going up faster than just the commodity price of natural gas. So for us, that's a good thing, of course. And then on the biocoal side, when we see, all of these net zero commitments by 2030, by 2050, solid carbon is needed in steelmaking for a lot of the chemistry to happen. So when you look at Ontario, you've got two of the steel mills receive pretty substantial funding, almost $1 billion between the two of them, to decommission blast furnaces, which use a significant amount of coal, and move to what's called electric arc furnaces. And they'll be kind of commissioned in around, I think both of them are supposed to be commissioned in around 2028. But these facilities still need, tens of thousands of tons of solid carbon for the chemistry aspect. And so you can either use metallurgical coal, which is going to give you greenhouse gas emissions, which we still believe are going to be priced in Canada, or you can use a biocoal, which doesn't generate those greenhouse gas emissions. So there's still significant savings on that front. And of course, with everything going on right now, most renewable products are priced at their comparative commodity plus sort of a premium for being green. And when, the price of metallurgical coal, a significant amount of it comes from Russia. And so the price as embargoes come in has gone up, substantially to the point that, we're almost at price parity with the current price of met coal. Plus we have all these benefits, right? And similarly with natural gas, certainly in Europe, the price is going up, and we're seeing it go up a little bit here. But, if those commodity prices, stay where they are, plus the green premium, that is all sort of, from a business perspective, supporting the case of the costs.
Yeah, gotcha. Okay, so let's talk about some of the challenges. What are the biggest challenges you guys are facing?
I mean, part of it is determining how we can accelerate project deployment. And it is, we've got Thorold, we've talked previously about Kirkland Lake, which is moving. We've got St. Félicien, we've got 4 or 5 other opportunities that are in the pipeline. And of course, I mean, being prudent, we're doing them kind of one at a time, and we're staging them to balance our capacity and our capital. So certainly being able to raise additional funds at even the project level could see these kick off and accelerate faster. And it hasn't been the best year for any kind of tech in terms of financing and fundraising. And like I said, I mean, because of that, we're sort of focused on one at a time. So we'll still get Thorold built, we'll get it to revenue, but we could be moving a lot faster. And I think we will start to move a lot faster once the sort of capital market conditions improve. And until that time, we'll kind of keep it sequential and make sure we're deploying projects and generating revenue. So that's on the one hand. And so it's interesting because it is almost a game of ensuring that we're focusing appropriately, because there's so many opportunities that come flying in here. So kind of balancing that resources opportunity mix is a bit of a challenge. We could certainly use more engineers and more project deployment, but that's certainly a solvable challenge.
Yeah, for sure. Remind everybody that's listening, if you've got a question you'd like me to ask Andrew, just please use the chat function, and I'll do my best to ask the question. Okay, time to take out the crystal ball a little bit. 2023. You guys have talked about what you want to see as far as timelines for the projects. Anything else to look out for in 2023? What should investors really be focusing on for you guys?
Yeah, I mean, and certainly the big one is the sort of deployment of Thorold. I think we've done a very good job at executing on these project development opportunities since we first started talking. Thorold was kind of a twinkle in the eye, and now it's real, and we've got the money to do it. Certainly now that we've been able to announce it and talk about it, I think we're in a position that we'll be able to provide investors and stakeholders more frequent updates. There's certainly challenges as you're trying to negotiate that type of funding to talk about certain things. So it's great to be able to sort of provide those progress updates. And so as we get into sort of the end of 23 and into 24, and these build own operate projects start to generate revenue, in the interim, there is still this anaerobic digestate market, and there is still this biosolid market. And in those markets, we're not doing build own operate. We're basically selling projects, selling equipment. And there are enough highly developed opportunities there that as we go through 23, I certainly foresee a couple of equipment sale projects coming on as we continue to develop our own build own operate projects. So the pipeline is very robust, and we're eager to see the fruits of that sales cycle really start to come to fruition this calendar year.
And give us an idea what kind of a sale can you make? What's the figures attached to these type of project sales?
Yeah, I mean, ballpark numbers, kind of the smallest ones we're looking at, demonstration scale is on the order of $2.5 million US, and sort of a larger plant on the order of that. I should say a larger plant that we would see coming in the next 12 months would be in the $4 to $5 million range. And then we've got some larger projects, but those ones I think are a little bit further down the line, where we're adding, a lot more processing equipment. And then we're looking at, plants that are in the $15 to $20 million range.
And then Andrew, give us a sense, I guess, North America wide, what could be the addressable market? I have no idea how many of these plants or these different systems the market could bear, whether it's yours or somebody else's. Just give us a sense of size, if you can.
For sure. So we'll start on kind of the woody biomass build own operate market, because again, just to keep it clear, we're in the wood residual wood waste, we're building our own plants, and in the other markets we're selling plants. So in the wood space, it's much more what our capacity is versus what the market can bear. And to put that in context, we're looking at, kind of over the next few years, getting 5 projects deployed. Those 5 projects would be giving us 2.5 gigajoule or 2.5 million, 2.5 million gigajoules of renewable natural gas. 2.5 million gigajoules is 2 petajoules. And if you recall, Quebec needs 20, BC needs 30, California needs 136. So we are moving kind of as quickly as we're able to. And 2.5 million gigajoules, I think, is a great target for us, and it's an achievable, sort of slightly stretched target, which is the kind I like to set. But if you look at kind of what the demand is, we're such a small component. Similarly, on the biocoal, we're looking at individual sites that need 50,000 tons a year, and our Thorold project, when it's fully in production, will be producing 10,000 tons.
Right.
So we'll kind of need, 4 to 5 Thorolds to fully service one steel making client. So on the build, own, operate, for all intents and purposes, it's sort of infinite for now. Certainly, we have ambition to get to the point where we're actually making, solid chunks of these markets. On the equipment sales side, it's also an interesting space because, we'll look at biosolids, for example. We're not setting up our own plant, so we're partnering with those that are already managing biosolids, and no one is really doing thermal process except for incineration. But outside of some incineration plants, and which are not going to be permitted anymore, by the way, so there's not going to be any new incinerators. The market opportunity there is really, how do we manage the forever chemicals that are in biosolids, things like PFAS, and investors or people watching this might say, well, why are you doing wood and biosolids? Like, where's the connection? And the connection is the ability of high temperature pyrolysis to destroy these forever chemicals in biosolids. And there's not a lot of technologies out there that can do it. So there's a real opportunity to get some of these lumpy, but sort of fairly lucrative capital sales in the early stage of Char as we build out our build on operate projects. And so you've got, states like Maine that have now banned landfilling of biosolids. So we can't spread it on fields. We can't put it in the landfill. Like at this point, the question is what is done with it? And high temperature pyrolysis is one of the only remaining options. Or shipping it out of state, and then that gets into all sorts of EPA issues as well. So from that market perspective, the opportunities are significant, and we're nowhere near sort of butting up against any kind of capacity for market to absorb what we're offering.
It definitely sounds like it. Take a different direction here a little bit. Sort of a lot of the ESG companies, the sector itself has been somewhat hit over the last little while. Microcap's been hit over the last little while. So you guys are sort of covering both of those right now. What does the investor appetite look like right now? I'm assuming you're talking to a lot of investors, analysts, everybody up and down the street. What's the interest level look like now compared to what it was a couple of years ago, and what can you tell us about that?
Yeah, I mean, compared to a couple of years ago, I mean, it's not just, ESG or microcap, it's sort of all tech, I think everyone's kind of taken a hit. And I think, when you look at some of our peers, I think we've actually fared reasonably well. Obviously, we want to see growth and not a little bit of a flat or, decline from some of the highs, but sort of compared to the peer group, we've fared pretty well. I would say there's very good interest, but there's kind of that, when's the right time? When's the sort of, market going to really be interested in deploying capital? So I think the analyst conversations have been fantastic. The bank conversations have been great, the brokers and the like, and sort of everyone's following the story. And I think we're just kind of waiting until there's a general appetite to start seeing capital deployed again, and whether that is in January or March or what. I mean, it's certainly the crystal ball aspect, but I think from a clean tech perspective, I got to say I'm happy with our positioning. I'm happy with the feedback we're getting from like analysts and brokers and the like. I'm happy with our overall positioning, and we have the ability to deploy Thorold and to make these equipment sales, with our existing resources. So, we're going to keep on that track, and when we see sort of the right opportunity with the right conditions, I think we would certainly consider additional investment. But we just got to, unfortunately for the speed I'd like to move at, we have to be a little patient. But I think the credibility is there, the positioning is there. We just need sort of the rest of these sort of macro factors to line up here.
Now, Andrew, we've been talking for a couple of years now, I think, and I think when we first started to talk, there seemed to be some questions around whether the technology is, ready for sort of the big leagues. I think we've certainly gone past that, and it's safe to say that technology is proven. I'm just trying to sort of get the landscape of where the risk is here now. Is it really just execution? Like, you guys have to sort of show that you commercialize this on a grander scale, or where do you think the investor needs to sort of understand where the risk is here?
Yeah, I think that's not, I don't think that's wrong. I think, execution risk, we've got Thorold lined up. We've got this, with FedDev, just over $12 million to work on it. But, absolutely, it's proving it out. I mean, this is the first project of this scale that we've put together. Now, our team have built, much larger infrastructure projects. So I think we've done a lot to mitigate those risks. But certainly from what has Char done, this is certainly a step forward. The majority of the technology that we're sort of adding in, most of that componentry is relatively off the shelf. Like, we've certainly taken the approach of what's the piece that we do well, and let's find others who do all these other pieces well to integrate it all together. So we're not trying to reinvent stuff that people have done that works, and that'll get us going. We got to keep our core IP, obviously, and if it's not core to our IP, then let's bring in the best that we can find out there. And certainly once Thorold is in place, then the nice thing is it really puts us in a position to have access to a number of different financial instruments for projects 2 and 3, projects like Kirkland Lake and St. Felicien and further on, because now the real risk adverse, like the charter banks and all the other project finance and debt opportunities can come and see Thorold works, and that's sort of the piece that they need to see. They take basically zero scale up risk, which I get. So, we'll have Thorold done. They can come see it, and then we can have a different approach to future project development, which will be fantastic.
Right. Yeah. Fantastic. Well, listen, I think we've sort of covered everything I can think of. Is there anything else you want to sort of highlight? Is there any sort of key takeaway you want to make sure everybody walks away with today?
Yeah, I mean, as you ask, I mean, there's a couple of things that all play together, but certainly technology, ESG, microcap have all been hit in the last kind of 12 months. It was kind of started with Omicron around this time last year, and then kind of hit a little harder in January. But we have sort of a well-established story now. We've got a good pipeline. We've, I think, really demonstrated the credibility when we, spoke kind of a year ago. It was, we're going to build BOO projects. We now have it funded, and we're moving it forward. And we're going to keep taking that general approach. The fact that we have this 12 million with the FedDev, over 12 million to build out Thorold means we get that project to revenue with the money we have from that funding, which I think is crucial for people to really see as we get into these larger projects, we get into that really commercial deployment and recurring revenue opportunities. And that'll be through 2023. So I'm, depending on where the market is and the appetite for ESG, I mean, if we look at everything else going on in the world, as you asked about, the Inflation Reduction Act, the fall economic statement, certainly what we're going to see, and I'm sure what we're going to see in the next federal budget, the ability to raise the kind of government support that we have. Clean tech is not going away. Environmental technologies aren't going away. Climate tech is going to continue to be crucial going forward. Greenhouse gas emission reduction is not going away. It's crucial, I mean, from a personal perspective, it's kind of crucial to our overall survival, but from a business perspective, it's there. It's not going away. So, I think we're going to be really set up for a pretty amazing 2023, and I'm really looking forward to it.
Fantastic. Well, first off, congratulations on the success so far. You've delivered on what you said you would when we've had our last couple of conversations. Congratulations on the funding. I think that's a significant validation as well. And look, it's always good to catch up and appreciate your time. And want to thank you again, and certainly look forward to catching up with you again, Andrew, and continued success.
Appreciate it, Paul. Thank you, and to you and everyone on here. Happy holidays, happy New Year, and I look forward to giving another update in 23.
Fantastic. Happy holidays as well.
Okay.
Bye.
Thank you very much.